The lumber industry faces its own specific version of the tariff crisis, and it carries particular consequences for American housing affordability. Canada is by far the largest single source of softwood lumber imported into the United States. Canadian lumber fills a gap in domestic supply that American mills cannot currently meet from domestic timber harvests, and it has been a critical input for American home building for generations. The softwood lumber trade between Canada and the United States has been contentious for decades. A recurring cycle of American countervailing duties, Canadian challenges through trade dispute mechanisms, negotiated settlements, and eventual relapse into dispute. But through all of those cycles, the underlying economic reality that American home builders need. Canadian lumber has maintained a baseline of trade even in periods of elevated tariffs. The 50% tariff now applying to Canadian lumber represents a cost increase that will land directly on American home builders who will either absorb it in their margins or pass it through to the buyers of new homes. In a housing market where affordability is already a defining political issue, where the gap between wages and home prices has become a generational challenge in most major American cities, a supply shock to the lumber prices that raises the cost of new construction is not a minor economic footnote. The National Association of Home Builders has estimated that lumber price spikes in previous tariff escalations added thousands of dollars to the cost of a typical new home. A sustained 50% tariff on Canadian softwood lumber represents a lumber price shock comparable to or exceeding those previous episodes. The political consequences of higher home prices driven by tariffs on Canadian lumber, tariffs imposed in the context of a trade confrontation with a country that most Americans regard as a close ally, may create domestic pressure within the United States to revisit the tariff posture that produced them. Agriculture is the sector where the consequences of the tariff collapse are simultaneously most complex and most politically charged on both sides of the border. Canada is the second largest agricultural export market for the United States, a market that American farmers have cultivated over decades, and that represents an important revenue stream for grain producers, meat producers, and specialty crop growers across the American farm belt. Canadian retaliatory tariffs matching the American 50% rate will apply to American agricultural goods entering Canada, making them less competitive against Canadian domestic production and against imports from third countries that are not subject to the same tariff burden. American soybean growers, corn producers, and pork producers who have established export relationships with Canadian buyers will find those relationships suddenly and significantly more expensive to maintain. On the Canadian side, agricultural producers who export to the United States face the reciprocal challenge. Canadian canola, a major export crop that flows primarily into American crushing and processing facilities that use it for vegetable oil and biodiesel production, faces tariff costs that will affect the economics of existing supply relationships. Canadian beef and pork producers who have access to the American market through established trade flows face higher tariff barriers that will force repricing of those relationships. The agricultural consequences of the tariff collapse are not as immediate as the auto industry consequences. Supply chain disruptions in agriculture tend to play out over planting and harvest cycles rather than production line schedules, but they are equally real and equally consequential for the rural communities on both sides of the border whose economic health depends on cross-border agricultural trade. The question of what happens next, how the tariff standoff gets resolved, on what timeline, and at what cost to the people living through the consequences, is genuinely uncertain in ways that are not rhetorical. There are several distinct scenarios that analysts and trade policy experts are now mapping out, and the path that actually unfolds will depend on decisions that have not yet been made by governments that are themselves still processing the overnight development of the talks' collapse. The first scenario is rapid re-engagement. In this scenario, the economic consequences of mutual 50% tariffs become apparent quickly enough and painful enough on the American side that the Trump administration concludes the current posture is not producing the outcomes it intended and returns to the negotiating table with terms that are closer to what Canada needs. This scenario is more likely if specific American industries and constituencies, auto manufacturers, home builders, agricultural exporters, make their pain visible and politically salient quickly. The Trump administration has shown throughout its trade confrontations that it is responsive to domestic economic pressure from specific constituencies, particularly ones with strong geographic concentration in politically important states. Michigan auto workers, Ohio steel users, and southern states, home builders are all constituencies whose voices carry political weight. And if the tariff consequences become concrete and visible quickly, the political pressure to resolve them could move faster than typical trade dispute timelines. The second scenario is prolonged standoff. In this scenario, both sides maintain their positions. The United States keeping the 50% tariffs in place and Canada keeping its retaliatory measures for an extended period, while each side assesses whether the economic pain is sufficient to force the other's concession. Prolonged standoffs and trade disputes are more common than rapid resolutions, and they tend to be resolved not when the optimal deal becomes apparent, but when the domestic political pressure from the affected constituencies on one side becomes sufficient to move the government's position. A prolonged standoff at 50% tariff levels would produce significant economic disruption. Plant closures and supply chain restructuring in the auto sector, sustained elevated construction, costs, agricultural market disruption, at costs that would be felt by workers, businesses, and consumers on both sides of the border throughout its duration. The third scenario involves third-party escalation, a broadening of the trade confrontation beyond the bilateral tariff measures already in place. Canada has tools beyond tariff retaliation that it has not yet deployed. Restrictions on critical mineral exports. Canada is a major supplier of minerals including uranium, nickel, cobalt, and potash that American industry depends on, would be a more painful escalation that Canada has reserved as an option but not yet exercised. Canada could also revisit its position on American digital services companies operating in Canada, or take measures affecting the energy exports, oil, natural gas, electricity, that flow from Canada to American markets. These escalation options have been discussed throughout the trade confrontation as leverage Canada holds but prefers not to use, both because of the mutual damage they would cause and because of the political optics of a smaller country escalating against a larger one. Whether Carney's government concludes that deploying some of this additional leverage is necessary to shift the American calculation depends on how the negotiations, or the absence of negotiations, develop in the coming weeks. The fourth scenario, and the one that would most fundamentally alter the long-term trajectory of the relationship, is Canadian economic diversification that reduces the structural dependence on American market access that has made Canada vulnerable to this kind of leverage throughout the entire trade war. Canada's 75% export dependence on the United States has been identified throughout the crisis as the fundamental vulnerability that gives the American side its greatest leverage. Reducing that dependence, building deeper trade relationships with the European Union through CETA, expanding trade with Indo-I, Pacific markets through the CPTPP, developing new export channels for Canadian commodities, and manufactured goods in markets that are not subject to American trade policy, is a long-term project that cannot be completed quickly enough to affect the current crisis. But the current crisis has created the political urgency to actually pursue diversification seriously, rather than as an aspirational talking point. And the investments in alternative market development that a genuinely post-crisis Canada would make could alter the structural context of future trade confrontations in ways that the current one cannot. The path back to a functioning Canada-United States trade relationship, not just a paused tariff crisis, but a genuinely stable, mutually beneficial framework, runs through a renegotiation of CUSMA that neither side has formally begun, and that will be more difficult in the current poisoned atmosphere than it would have been if the bilateral tariff dispute had been resolved before the trilateral negotiation began. CUSMA was designed to be reviewed in 2026 and either renewed or renegotiated before its 2036 termination. The Trump administration has already signaled it would not extend the agreement. That means the current tariff confrontation is not just a standalone crisis. It is the opening act of a broader renegotiation that will determine the terms of North American trade for the next generation, the leverage each side brings to that renegotiation, the domestic political constraints each negotiator operates under, and the economic consequences that accumulate during the period of uncertainty before a new framework is established will all shape the outcome in ways that are not yet visible. What is visible, what is concrete and immediate and already happening as of this morning, is the cost being borne by the people who did not negotiate the deal that wasn't reached, who did not set the tariff rates that took effect at midnight, and who did not choose the negotiating postures that produced the collapse. The auto worker in Oshawa, whose plant is assessing its production schedule in light of tariff costs that have just fundamentally altered its supplier economics. The home builder in Texas, whose lumber costs just increased in ways that will land on the buyers of the homes she builds. The farmer in Saskatchewan, whose export contracts with American buyers are now subject to a tariff that neither parties anticipated when those contracts were written. The small business owner in Windsor, who has been watching the negotiations for months, and who woke up this morning to find that the resolution everyone said was close did not happen. These are the people for whom the abstract language of trade policy tariff rates, negotiating positions, retaliatory measures, CUSMA renegotiations, becomes completely concrete. They are the ones who will navigate the consequences of a diplomatic failure between two governments that share a border, a language, a history, and an economic integration so deep that most people on both sides had forgotten it was a choice rather than a condition of nature. It was always a choice. And the choice that was made or not made in the final hours before the midnight deadline will be measured not in the language of trade policy, but in the language of livelihoods, of communities, of the accumulated economic lives of people who built their futures around a relationship that both governments allowed to break down. The path back exists. Trade relationships that have broken down have been repaired before, between countries with far more hostile histories than Canada and the United States share. The economic logic of the integration that was built over 80 years does not disappear because tariffs have been imposed. It reasserts itself through the pressure that the costs of disruption place on the governments that created them. The question is not whether the relationship will be repaired. It is how long the repair takes, how much it costs in the interim, and whether the framework that emerges from the repair is stronger, more resilient, and less vulnerable to the kind of coercive pressure that produced the current crisis. The trucks are still crossing the border this morning. The goods are still moving. The trade is still happening. It is just more expensive in ways that are already being calculated by every business on both sides of the line that depends on it. The midnight deadline came. The tariffs switched on. And now the real negotiation, the one conducted not in conference rooms in Washington, but in the economic consequences felt by workers and businesses and communities across the continent, is just beginning.